Welcome back to the deep dive. Today, we're really getting into the weeds with some pretty specialized market analysis. Our goal here is to unpack the key movements from the trading week, that's Monday, September 29th, right through to Friday, October 3rd, 2025.
And yeah, this isn't just general commentary. We're working from proprietary material, specifically excerpts from the Financial Engine Weekly Market Summary. This is authored by Devin McClarty. It's owned by D Investment Enterprise LLC and published by D Publishing Group, a real deep cut.
Exactly, and we're focusing on the insights from their licensed IP, what they call their LoopMarket read. For anyone not familiar, LoopMarket is, it's their system for trying to quantify capital conviction. It lets you see where the money's really moving, with force beyond just the price changes.
That's a good way to put it. And the core finding for that specific week, according to McClarty's analysis, really nails this theme they highlighted, the tale of two markets. You see, the main indices look okay, finished higher, actually,
Yeah.
but underneath, a completely different story, a clear polarity.
A polarity, meaning the performance was really dependent on just a few specific areas.
Precisely. The market's strength was incredibly narrow, relying on a very select group of stocks.
Okay, let's jump into those top line numbers then, because like you said, on paper, things look pretty decent. Segment 1, index performance. The NASDAQ and the S&P 500 both ended the week higher. Pretty respectable gains, right?
They did. And even the Dow Jones managed a small gain, just crept into positive territory.
Yeah.
So yeah, if you were just catching the headlines, you'd probably think, okay, solid week for the market.
But that's misleading, isn't it? You mentioned it wasn't really healthy underneath.
Far from it. That's textbook misleading performance. When you dig into what drove those index gains, the concentration is, well, stark. The entire upside pretty much came down to just two sectors, technology and industrials. They were clearly the ones pulling the weight that week.
Okay, so if the NASDAQ and S&P are up, but only two sectors are really doing the lifting, that immediately makes you think about market breadth, or lack thereof.
Exactly. Poor breadth. The gains were concentrated, not widespread. And what's really interesting is the active weakness on the other side. You have to ask, okay, which sectors were actually pulling things down, acting as a drag?
Good question. Where was the weakness concentrated?
The analysis points straight at a rotation away from defensive plays. Consumer staples and energy. These were the consistent laggards all week. They were really weighing down any chance of broader market participation.
So you see tech and industrials surging, often signals of risk on sentiment, maybe optimism about growth.
Right.
But then the classic defensive areas like staples are just sinking. That contrast seems pretty significant.
It's a powerful signal. It tells you investors, at least for that week, felt the risk and growth was worth taking. They didn't feel the need for that safety net from defensives.
I wonder, though, how someone, say, managing their retirement funds should view that. Is that extreme concentration inspiring, like a sign of leadership, or is it more of a warning?
That's the million-dollar question, isn't it? And honestly, it's probably both. For short-term momentum traders, maybe it's inspiration. But from a structural perspective, it's definitely a warning sign. Because, when the tide is only lifting a couple of really specific boats, the overall market structure feels, well, shaky.
That leads us perfectly into tracking the money flow. Segment 2, market flows and investment themes. If we have this stark polarity, this tale of two markets, where did the capital actually go? That shows the conviction, right?
Absolutely. And the LoopMarket data, according to McClarty's summary, is really clear on this. Conviction was almost entirely focused on growth themes. Technology inflows were described as especially strong.
Especially strong.
Yeah, and the data apparently showed that the high beta momentum names within tech, they specifically mentioned HPE as an example, were grabbing outsized gains. This wasn't just a gradual shift, it was a very deliberate, very targeted push of capital into specific opportunities they thought had high return potential.
Okay, so if money is flooding into tech momentum, it makes sense that defensive areas would see the opposite, right? You have to fund those growth bets somehow.
Precisely. Defensive sectors saw what the report termed sideways to weak flows. So capital was either moving out of perceived safety or maybe just staying on the sidelines, refusing to buy the dips in those areas. It was leaning hard into growth. That active rejection of defensive sectors is, well, it's one of the stronger signals of market conviction you can get.
But it wasn't like all the non-growth areas were tanking, were they? I noticed a couple of sectors sort of held their ground.
That's right. There was some middle ground.
Like financials. You'd think if there's optimism driving tech, maybe financials would catch a bid too, with growth hopes or rate expectations. But the report called them neutral. Why was that?
That's a great observation, and it shows the nuance here. The analysis did note financials were largely neutral, no strong inflows, but no major outflows either, kind of treading water. The report suggested this might have been due to some mixed signals on, say, broader economic policy at the time. It kept investors maybe a bit cautious about longer-term financial commitments, even while they were happy to chase that short-term tech momentum.
So the conviction was high, but very specific. A belief in certain high flyers, maybe not necessarily a broad belief in the whole economy lifting off.
Exactly. And meanwhile, you also had healthcare holding what the report called a steady bid. That provided a bit of relative stability elsewhere. So picture it. A focused rush into tech, an active move out of staples and energy, and then these two big sectors, healthcare and financials, just kind of holding steady.
Okay.
And connecting that back, it just perfectly reinforces that concentrated rally narrative. The index gains happened because investors were actively selling defense to fund offense.
Right. And speaking of specifics, let's make this more concrete. Segment 3, momentum highlights and case studies. Let's use the watch list details from the report to really show how concentrated those gains were. Give people some actual stock examples.
Yeah, the analysis provides some really potent examples using their proprietary metric, the beat streak. Just to clarify for listeners, a beat streak in their system means consecutive days where a stock significantly outperforms its sector average. It's a sign of sustained internal buying pressure, that capital conviction we talked about.
Okay, got it. So who was the star performer based on that?
The absolute standout leading the weekly gains was RCI. This stock extended what they called its historic beat streak to an incredible 21 days.
21 days, wow. That's 3 straight weeks of significantly beating its sector. That's quite a run.
Phenomenal run. And, historically, streaks like that don't last forever, but it just shows the intensity of the focus on that one name during that period.
Was it alone up there?
Not entirely alone in showing strength, no. WU was another one noted for its steady ascent. It crossed into double-digit beat days, hitting 10 consecutive days itself. Still impressive.
And let's circle back to tech. You mentioned HPE capturing those outsized gains due to strong inflows. How did it look on this beat streak metric?
HPE is the perfect case study here. It wasn't just up. The report highlighted its clean breakout. It moved into what they term sustained leadership mode. This stock was basically Exhibit A for that powerful, targeted institutional demand for tech momentum names.
Okay, so that paints the picture of the winners. But the theme was a tale of two markets. So we need the other side. Who is on the casualty list?
Right. To really get the polarity, you need the underperformers. The analysis singled out HSY as the clearest underperformer for the week. This was seen as a direct consequence of that persistent weakness and the outflows from the consumer staples sector. HSY's lag streak deepened significantly.
And a lag streak is just the opposite, I take it. Multiple days of underperforming its peers.
Exactly the inverse. HSY consistently performing worse than its sector average. Its deepening lag just confirmed that the weakness in staples wasn't some random blip. It felt like a sustained, deliberate withdrawal of capital from that area.
So you've got RCI soaring for 3 weeks on one side, fueled by these targeted buys.
Right.
And HSY sinking on the other, dragged down by sector liquidation. That really does visualize the division sharply.
It's about as clear a picture of market polarity as you can get.
So with that extreme division, that concentration in winners and clear abandonment of losers, what did the system itself, the LoopMarket methodology, ultimately conclude about this whole environment?
Good question. That brings us to segment 4, the system read and synthesis. What's the bottom line from the McClarty analysis? Well, the core summary just hammered home that clear polarity. It confirmed the market's upside was almost entirely dependent on that narrow band of momentum leaders.
And crucially, it also said that most other stocks, the report said many names, were basically stuck in neutral or actively underperforming, right?
That's right. And this is key. The breadth did not improve meaningfully during the week. The gains stayed locked within those top names. Period.
It's interesting, though, that they also noted their own system was working well in this kind of market.
Yeah, they did point that out. They mentioned strong win rates among breakout and momentum triggers and specifically cited successful calls they apparently made on HPE and another stock, USPH. They felt this reaffirmed their methodology's edge, especially in what they called resilient market conditions.
Resilient. That's an interesting choice of word. Not healthy, but resilient.
Exactly, because it wasn't broad-based health, it was resilience, because that small core of leaders was strong enough to offset the selling elsewhere. elsewhere and still push the main indices up. It really highlights a dependency, doesn't it? A dependency on a very powerful, but ultimately very small group of stocks.
And that dependency, that's really the so what for listeners, isn't it? What does that concentration actually imply going forward?
That's the critical takeaway. The implication is fragility. Think about it like a basketball team, where maybe only two superstars are scoring 80% of the points.
Okay.
As long as those two stars are healthy, playing at peak performance, the team wins games, looks great on the scoreboard. But the moment one of them gets injured or even just has an off night,
The whole team could collapse because nobody else is picking up the slack.
precisely. That's exactly what highly concentrated market breadth implies for the overall index performance. It's vulnerable.
So the stability we saw in the indices that week, September 29th to October 3rd, it was potentially masking an underlying vulnerability. The market was up, but only if you happen to be in tech or industrials, and really only if you held specific names like RCI or WU or HPE.
That's the core lesson. Index strength doesn't always equal market health. Sometimes, oftentimes perhaps, it just means a few heavyweights are doing enough to hide weakness elsewhere. Understanding that difference is absolutely crucial for thinking about risk.
Okay, so let's recap our deep dive into this Devin McClarty loop market analysis for that week. The market's advance was real, yes, but it was driven by intense concentration. Investors were actively selling defensives like staples and energy to pile into specific growth names, mostly in tech. This created a very clear two-tiered market.
And that leads us to the final provocative thought for you, the listener, to mull over. If that week's gains truly relied so heavily on that narrow group of momentum leaders, what might happen to the S&P 500, to the NASDAQ, if just one or two of those key high flyers, the RCIs, the HPEs, suddenly stumbled? What if that 21-day beat streak suddenly snaps? Think about how quickly that hidden fragility, the risk inherent in such concentrated market breadth, could suddenly become very, very real. That's the underlying tension to keep an eye on.